Hi, and welcome to the first of a new set of videos which are going to be looking at additional topics for first year microeconomics. In this first set, we're going to be looking at foreign exchange markets, and we're going to start off by asking a simple question: what is an exchange rate? So let's start with a really simple question first. What is the price of $20? So here is 20 Australian dollars. What would you be willing to pay for that? Well, I'd be happy to give you two $10 notes for the $20 note. Or I'd be happy to give you four $5 notes for a $20 note. But this is all just really saying something pretty trivial. The price of a $20 Australian note is 20 Australian dollars. But let me ask you a different question. Would you be willing to give me 20 US dollars for my 20 Australian dollars? Or how about 20 New Zealand dollars for my 20 Australian dollars? Or even 20 Hong Kong dollars? Of course. Why does it have to be 20 for 20? How about we have 10 Croatian kuna? Is that worth $20? Oh, maybe about 10 Peruvian soles. Is that worth our 20 Australian dollars? What else do we have? Well, maybe 100 Indian rupees. Surely 100 for 20. That's got to be worth not enough. How about we offer you 500 Indian rupees for your $20? What's the right price for $20 Australian when you're talking about other currencies? An exchange rate is simply the price of one currency in terms of another currency. It might be euro per Australian dollar, Indian rupee per Australian dollar, or US dollar per Australian dollar. These are each prices of one Australian dollar in terms of the amount of another currency, the euro or the Indian rupee or the US dollar, that you have to give up to buy an Australian dollar. And when I'm recording this at the beginning of 2018, you would have to give up about 2/3 of a euro to get one Australian dollar. If you were trying to buy an Australian dollar with Indian rupees, then you'd have to give up around 50 Indian rupees to get an Australian dollar. But if you wanted to use US dollars to buy an Australian dollar, well, that would be about 79 cents, so 0.79. That's the price of an Australian dollar in terms of euro, about 2/3 of a euro. In terms of Indian rupees, 50 Indian rupees, or 79 US cents to the Australian dollar. Notice that if the price of an Australian dollar in terms of euro is 2/3 of a euro per Australian dollar, we can immediately work out what the price of a euro is in Australian dollars. If it takes 2/3 of a euro to buy one Australian dollar, then we know that with an entire euro, we'll be able to get 3 on 2, or 1.5 Australian dollars. So if our 1 euro buys 1.5 or 3 on 2 Australian dollars, that's the same as saying that we need to give up 1.5 Australian dollars to get a euro, or in other words, the price of a euro is 1.5 Australian dollars. Notice that we've just got inverses here. The price of an Australian dollar is 2/3 of a euro, so the price of 1 euro is simply 3 on 2 Australian dollars. And similarly, if it's 50 Indian rupees to buy 1 Australian dollar, then the price of an Indian rupee in terms of Australian dollars will just be 1/50, or about 2 cents Australian to buy an Indian rupee. And if it costs 80 US cents to buy an Australian dollar, or about 4/5 of a US dollar to get an Australian dollar, then the US dollar will cost 5 on 4, or about $1.25 Australian. We also know that exchange rates, or prices of currencies in terms of other currencies, will be consistent. What do we mean by that? Well, suppose the price of €1 is 1.5 Australian dollars. I've just used AUD, which is the symbol for Australian dollars. And the price of 1 Australian dollar is 50 Indian rupees. Then we know that the price of €1 must also be 75 Indian rupee. Why? Well, to buy a euro, we need 1.5 Australian dollars. But if it costs 50 Indian rupees to buy 1 Australian dollar, it will cost 50 and a half of 50, 25. So 75 in total. 75 Indian rupees to buy the 150 Australian dollar needed to buy the euro. So the price of €1 must be 75 Indian rupees. And that will always hold. The cross rate, which is what we sometimes would call this, has to be derived from the other direct rates. And if that wasn't the case, then there would be lots of free money to be made. To see why that must be the case, let's imagine it didn't hold. Let's imagine, for example, that, in fact, the price of a euro was 100 Indian rupees. You would now be able to make free money. How? Well, suppose you had €1 to start with. You sell that, you get 100 Indian rupees. Now, with 100 Indian rupees, you can buy 2 Australian dollars. 50 Indian rupees for one, so 100 is 2 Australian dollars. But now you can take $1.50 of that 2 Australian dollars, get your original euro back again, and still have 50 Australian cents left over. So if the cross rate was not derived from the direct rates, there would be what we call an arbitrage opportunity. And an arbitrage opportunity means that by buying and selling currencies, you will be able to make riskless, free money. So we know that those cross rates are always going to be given by the direct rates. So now we've been able to talk about the price of a dollar, or at least the price of an Australian dollar in terms of other currencies such as the euro, the US dollar, or the Indian rupee. We can talk about those prices or exchange rates and the relationship between them. But where do they come from? Well, like most prices, we'd expect them to come from a market. And in the next video, we're going to start looking at the market for Australian dollars. Why do people buy or demand Australian dollars? And why do they supply Australian dollars? And from that, we're going to start understanding what drives the exchange rate. Thank you for listening.